Welcome to your investing journey, avoiding common pitfalls. Hey there. I'm thrilled you've decided to dive into the world of investing. It's an exciting and sometimes overwhelming place, but you've got this guide to help you navigate it. I've been teaching investing basics for years, and frankly, I've seen the same mistakes trip up beginners time and again. This isn't your run-of-the-mill guide, it's a conversation with someone who's been there and genuinely wants to see you succeed. So, why does this guide exist? Because investing doesn't have to be daunting. It's about making informed decisions, understanding the game, and maybe even enjoying the ride. Let's jump in and explore how you can sidestep those common blunders and become a savvy investor. Understanding the basics, where most get stuck. First things first, how do you feel about risk? Probably not your favorite topic, right? But here's what's interesting, understanding your risk tolerance is absolutely crucial. I remember when I first started, I thought I was a daredevil investor until a market dip left me sleepless for nights. Turns out, my risk tolerance wasn't as high as I'd imagined. It's a deeply personal assessment, and getting it wrong can lead to costly emotional decisions. Emotional investing, believe it or not, it's incredibly easy to let emotions drive your decisions. You see the market dip, panic, and sell everything. But here's a pro tip: try to keep your emotions at bay. Stick to your plan, and remember, markets fluctuate. A 2023 Dalbar study, for instance, uncovered a startling truth. Over the past 20 years, the average equity investor has lagged the S&P 500 by almost 4%, a gap largely attributed to investor behavior rather than fund performance itself. Frankly, that's a significant amount of potential growth left on the table. Lack of diversification, putting all your eggs in one basket? That's a rookie mistake, and a surprisingly common one. Diversification, or spreading your investments across various assets, can help you spread risk and increase your chances of hitting those investment goals. It's like building a team. You wouldn't want all offensive players, would you? Historically, a diversified portfolio can even help stabilize results and improve potential returns. For example, even during a turbulent year like 2022, a more diversified 60-40 portfolio, U.S. stocks and investment-grade bonds, held up better than a basic one, losing about 14% compared to nearly 17%. Building on the basics, the subtleties of strategy. Here's a question for you: have you ever heard of analysis paralysis? It's when you overthink to the point you never make a decision. That's surprisingly tricky in investing. The market's full of data, but don't let it paralyze you. Make informed decisions, and trust your research. Sometimes, the best decision is simply to act. Another interesting point: timing the market. Some investors obsess over finding the perfect moment to buy or sell. Spoiler alert, it's nearly impossible to consistently time the market. Instead, focus on time in the market. Consistent, long-term investing often yields far better results than trying to outsmart the system. Data consistently shows that those who remain invested benefit from compounding and long-term economic growth. In fact, missing just the 10 best-performing days in the S&P 500 over a 20-year period can reduce overall returns by more than 40%. That's a powerful argument for patience, isn't it? Advanced insights, investing like a pro. Let's explore something more nuanced than it appears: understanding fees. They might seem small, but they can eat into your returns over time in a truly frustrating way. Always check the expense ratios and transaction fees associated with your investments. One client taught me that even a seemingly minor difference can significantly impact long-term growth. To put it into perspective, consider a $150,000 portfolio earning a 6% annual return over 15 years. With a 0.8% annual fee, it grows to roughly $320,869, but with just a 0.2% annual fee, it could reach $349,443. That's a difference of over $28,000, simply due to fees. It's why I always emphasize scrutinizing these seemingly tiny percentages. And what about tax efficiency? It's not the most glamorous topic, but it's essential for maximizing your net returns. Consider tax-advantaged accounts like IRAs or 401ks. I've seen countless investors overlook these, only to pay more taxes than necessary. Think of them as special savings vehicles designed to help your money grow faster, often tax-deferred or even tax-free. It's a strategic move that can significantly boost your wealth over decades. Answering your questions, the curious investor. Many of my students ask, How much should I invest? It really depends on your financial goals, risk tolerance, and time horizon. A good rule of thumb is to invest what you can afford to lose, especially when you're just getting started. Don't stretch yourself thin. Investing should enhance your life, not add undue stress. Another common question: what's the best investment? There's no one-size-fits-all answer, and frankly, anyone who tells you otherwise is probably selling something. It's like asking, what's the best ice cream? It depends on your taste. Stocks, bonds, real estate, they all have pros and cons. My personal preference leans towards a balanced, diversified approach that aligns with your specific goals, rather than chasing the next big thing. Personal recommendations and next steps. By now, you've got a solid foundation and some advanced tips in your arsenal. So, what's next? Keep learning. Read books, follow market trends, and perhaps, find a mentor. Investing is a journey, not a sprint, and education is your best ally. I've always found that the most successful investors are the ones who never stop being curious. I recommend starting with a small amount and gradually increasing your investment as you become more comfortable. It's like learning to swim: start in the shallow end before diving into the deep. This approach minimizes initial risk and builds confidence. Remember, mistakes are part of the learning curve. The key is to learn from them and keep moving forward. I'm truly excited for you and can't wait to see where your investment journey takes you. Tags: investing basics, common investment mistakes, risk management, diversification, investment strategies, market timing, tax efficiency, investment education. Sources 1. anchorcapital.co.za